My name is Rodman Schley. As a real estate expert, I've invested millions of dollars in vacation properties all around the world, and I've been involved in the valuation of billions of dollars of properties. I want to share my 35 years of experience along with vacation home investment tips from the top minds in the short-term vacation rental industry. Now, let's do the work. Welcome to the Vacation Property Secrets Podcast. I'm your host, Rodman Schley, and today I am pleased to introduce Drew, the house hacker Hittner. Drew is the founder of Hostlo and a specialized lending partner for individuals that are seeking to build wealth through real estate. He's an STVR investor, a AirBNB superhost, and he's built a multi-million-dollar real estate portfolio, igniting his passion for non-QM lending. Drew, welcome to the show.
Thanks for having me.
No, I'm really happy to have you here because a lot of people, the last thing that we want to think about when we're buying short-term vacation rentals is the lending process. It can be brutal, it can be tough, it can be difficult, but you're the guy that's going to kind of walk us through what we need to know, especially when it comes to short-term vacation rentals, because so many people are, they're entrepreneurs, so they don't have that regular paycheck, or they don't have that typical qualifying paperwork or those structures that you need to get traditional financing. So I talked a little bit about the introduction. I got to know right out of the gates, what in the world is the house hacker?
That's a nickname that another one of my friends that started in the loan business with me just gave me, because he knew the term, but I didn't know the term at the time, and I bought as much house as I could, 6-7 years ago, and then I called it house hacking, just like anybody would credit card hack or travel hack, and moved people in, filled up the rooms with Airbnb renters, and I called it house hacking, and kind of stuck ever since.
Nice. So you own a lot of Airbnbs yourself. What does your portfolio look like?
Smaller than what it was. So I've been an Airbnb superhost since 2015. I've had up to 13 that I'd self-managed myself across 3 states. And in the last couple years, I don't think Airbnb bus was a real thing, but I just decided that I wanted to focus more on helping other people get them. And so I got rid of some of the stale properties or headache properties, kept the ones that I liked, and then focused a little bit as the lending business kept growing. I just figured that was better use case of my time. And so we're down to 6. So we cut it in half. I was under contract on another one in April, but I didn't like the inspection report, and we pulled out. So currently in the hunt.
I think that's one of the great things about short-term vacation rental portfolios. It's not like a big apartment complex. So some people come in, they buy these big apartment complexes, and then if they don't like it or if it's underperforming, it's really hard to liquidate and move it. Where if you got a short-term vacation rental, you just stick it on the market, you sell it, you put it in somewhere else. You got multiple markets going on. Maybe you've got one market that's not doing well and another market that is, and you figure that out and go, well, I'm going to take the money I have from here, move it over here, and capitalize on this market. So that's one of the great strategies about the short-term vacation rentals, that some people with the big portfolios of apartment complex, office buildings, retail centers, they don't have that luxury that they can move quickly. They're more like that freight liner that moves slowly and turns slowly, or we can be a little bit more nimble. So you've got, let's talk a little bit about lending. One of the reasons I brought you on today is I want to really talk to people and give them educations on different types of lending, because so many people get in and go, well, now what? Can I get a conventional? Do I have to go non-traditional? You specialize in short-term vacation rentals. So what types of lending products do you have, and what are the advantages of those versus traditional lending?
Yeah, so it's a great question. So, this is probably a self-proclaimed nickname that I would tell some of my referral sources, FAs, agents, title companies, you name it. The turndown lender. So me being a broker, I have access to literally 1 million lenders. And so what that does, it allows us to have very open and receptive guidelines to people that have challenging, or they think are challenging situations. And so to keep it super simple, we do have like Airbnb loans, right? So it's just like, I don't care if you're unemployed. If you got money for the down payment, we don't really care where it's coming from, as long as we can make business sense that it'll work. And business sense, you can use AirDNA, or we need some other justification letter that is going to back up the business profit and loss sense of that. But typically what I tell people is like, hey, look, we need one of three things to find a loan: good credit, income, or good assets. If you have all three, you're going to qualify for everything. If you have two of three, you're going to qualify for most. But if you have no credit and you got a lot of cash, you're going to qualify for something as well too. If you literally, it doesn't matter. You got to have one of three, and you can't be, really weak on the one of the three. You got to have like a strong base. And so that's where we start. And then I just have the people tell me, like, if you put your head on the pillow at night, you imagine this portfolio that you're building towards, what's the loan product that you think gets you there? I know nobody dreams about loans, but if you have to make yourself take action, financing is going to be a part of it. How do you see it fitting together? And then, sometimes it's otherworldly, but a lot of times we can figure out a product pretty easily after a short call.
Yeah. So when people come and you're talking about income, when you're talking through income, is that income through a W-2? Is it income through another business? Or is it income that can be generated through an Airbnb or maybe existing income that's coming into a home?
Yeah. And even proposed income, right? So all of the above we would take. And we have answers. So typically where people get tripped up in the entrepreneurial world, where you said W-2. So W-2 is the gross amount. Mm-hmm. So that's how all conventional loans are written, is on the gross amount for employee type loans. But when you're self-employed, Fannie and Freddie, FHA, all those products say, we take the net amount. We're not going to give you a government subsidized loan while we watch you not pay any taxes too. So we have other business statement loans where, like, hey, look, I know you make $1 million, but it says you lose $300,000 every year. You're not going to qualify for Fannie in a lot of those cases. But we have like business statement loans that let you use the gross amount. So in a case where you make $1 million a year, that's $83,000 in usable income on a monthly basis. And that's how you qualify on mortgage payments in the mortgage world, is based on your monthly average of the annual amount.
Yeah. So what kind of down payment are people talking about? I mean, we're talking about a traditional 20% down to qualify into those loans?
Yeah. So self-employed, somebody wants to buy a step-up home, so they got a $500,000 home and their business has been doing really well. And they're like, well, maybe I'll keep this house I'm in now as a rental. I want to go buy a nice step-up home for $1.5 million. And I don't know if that's everybody, but that's probably not uncommon in like San Diego or San Francisco. Yeah. And all they need to put down, giving those three things are in good shape or average shape, is 10% the least. 20% gives them a little bit better leverage, better rates, but you can put 10% down and there wouldn't be any private mortgage insurance or PMI included in that payment.
Oh, really? Even on a 10%? That's pretty good.
Yep.
What about, what is in terms of the time it takes to get the underwriting done? Are you talking about a 30-day period? Are you talking about a couple weeks? What's pretty typical for those?
Yeah, I always tell everybody 30 days. And I say, I can tell you and refer you to people that we've got it done quicker, but you never know when there's going to be something show up on title about water rights, or there's always something. That every loan and purchase transaction is a snowflake. So I typically say 30 days, but we can close loans in 6 days as well too. So it's just, it's all dependent on the situation.
Gotcha. Do you get these people pre-approved, just kind of like a traditional lender would, and so they can take a pre-approval letter in and negotiate with that?
Yeah, exactly. So, we have them work with one of our team members. We just inundate them with some document requests. And that's where a lot of people feel like they get dragged through the mud, because doing loans it's not a blockchain product. It's not based on efficiency and ease like in the digital world that we're so used to and accustomed to. It's still based on old standards. But we try to make that as efficient as we can. So after we do some document collection, we get a basic idea. If somebody talks to me on the phone or one of my other team members, we can do a pre-qualification, like, hey, dude, you're going to qualify for about this much. Sometimes the agents don't want that, though. They want somebody to really look at their credit, examine their income. And when we do that, we'll just have a basic call, send in some documents, and then we have what's called the clear mortgage plan, where we'll say, hey, you can qualify for to a rate as low as this. This will be your out-of-pocket. This will be your payment. But you as a borrower might not know this, but you have a choice of what interest rate you choose. And you can choose a rate that's higher than the lowest one, and then your closing costs will be less. Your payment might be slightly higher, but your cost, you'll get to keep more money in your pocket whenever you close on the home.
So when you're dealing with people, you're giving them options. So do you do traditional or non-traditional? You can kind of take somebody through that gauntlet, or do you just kind of focus on the non-traditional?
Yeah, so it's a nickname that I've given the process. We call it the totem pole approach, right? So we have 0% down home loans, right? And so are you a veteran or a first-time homeowner? No and no. Okay, you don't qualify for that. USDA too, but that's pretty rare. Like what? Okay, what do you qualify conventionally? Yes, we think you do. Okay, cool. So 3 or 5% is what you can do. Oh, you want to buy an Airbnb, and you still qualify conventionally. Okay, so the minimum down is 10%. And then it's like it's based on answers to the questions that we asked through the Clear Mortgage Plan and just the general loan consultation. So,
gotcha. So you start getting people going through, and you've got all these different options. It sounds like, and everybody is going to be different. That's the thing about any kind of lending. There's no one size fits all. Everybody's different. Everybody's got different income streams, which got to make your life just messy. It's probably good that you've got that yes/no flow chart where you can take people through and try to get them whittled down as quickly as you can. But what about that person who's sitting there and they're thinking, well, if I have to come in, and again, a lot of these people who are buying short-term vacation rentals, they're entrepreneurs, they're business owners, they're self-employed. Like, I know there's a big difference between my a W-2 wage and then kind of what I'm showing as a entrepreneur in terms of my, how my taxes are laid out, what I'm writing off, what I'm reporting, those kind of things. So when you're looking through those things, there's got to be some sort of a premium. I know that the rates are all based on risk, right? Our whole life is risk, and that's how you look at even an investment. The higher the risk, the more return you want to get. So when you're talking about loans, I'm sure you've got to factor that in too. But what kind of premium, if you look at a traditional, conventional loan, and then you start thinking about the premium on stuff that's kind of outside of the box, what are we talking in terms of premium there?
Yeah, so I would say anywhere. It depends on if everything is across the board equal. So if they qualified conventionally, but they're like, let's just do a non-conventional loan because I want a product that's slightly worse, right? Which nobody would do. We wouldn't allow them to do that unless for some reason I work for the consumer or the borrower, unless for some reason they wanted that. But that's never really happened. But the margin difference is pretty minimal. Typically, it's like 3/4 of a rate to like a point. Just depends on the product, but it's not bad.
Okay. No, I was thinking you were going to tell me it's going to be about maybe 300 basis points or a 3% type premium, but
no, it's not like if you went from like an FHA or a VA interest rate compared to like a DSCR investment property rate, that's where you can or like a hard money, an FHA or VA home loan compared to like a hard money fix and flip loan, that's a difference, right? That's a difference of 300 basis points at least.
Yeah.
But if you're talking about somebody who wants to just buy a turnkey home and they're self-employed and they're asking themselves, like, should I really do my taxes right next year to go get the house that I really want? I don't think the ends justify the means personally, because I would way rather pay those are the loans I qualify for, are the ones that on taxes, we all know the game you play, where I try to show the least amount because I know that margin isn't a big enough deal to affect me. Me paying Uncle Sam, 5 or 6 digits extra.
Yeah.
It affects me a lot more than anywhere from 3/4 to a point-ish more in margin or basis points, basically.
Yeah. So you kind of talked about those 3 different things. You talked about the down payment, right? You talked about the basically income. And then what was the third one? Credit score, right? So all 3 of those things, I'm sure those get taken into account too when it comes to the interest rate. Again, kind of because if you get a bad credit score, you're probably going to be a higher risk. or maybe you're not even going to get the financing on top of it. But, I would assume that those things have a pretty big impact on the interest rate that you're going to pay.
Yeah. So, but there's always a loan. There are literally loan products for people that are one day out of bankruptcy. Now, it might not be the shiny object interest rate you see on a Google search.
Yeah.
But there's still ways because real estate is such a hard asset. There's somebody out there that is willing to leverage against that asset. And just because somebody filed a bankruptcy doesn't, and that investor's mind doesn't mean they're not willing to continue making payments going forward. And so, yes, if you came right out of this is the worst case scenario, right? We've originated like one or two of these loans, but you're going to have more down payment for a loan like that, right? You're not going to be able to do that with 5% down. So wherever you're not leading in one of those three factors, the compensating factors have got to be great. So bad credit, you got to have either income that's really, really strong, or you got to have assets that are really strong.
Yeah. We talk a lot about, when I'm talking to a lot of investors, we'll talk about, the returns on your investment. And a lot of times we'll start off with the cash on cash. What kind of threshold are you looking at, cash on cash? What's that cap rate you're looking for, that rate of return that you're looking for? And you can really expand that, or you can really up your returns if you leverage the property, but you got to leverage it correctly, right? It's one of those things where, of course, the higher the interest rate, the lower the return is going to be on that cash that you put into the deal. So you always got to be aware of, number one, what that interest rate is. And number two, do the models, do the pro formas, look at the cash flows to see what impact that lending is going to have on what you're doing. So in terms of interest rates, I know we've gone through some pretty big interest rate hikes here. I should say big. It's big in comparison to where we were, right? And they were fast. And, we're August of 2024 right now. And I know the Fed's talking about starting to reduce these rates, which should be great for all of us. It should be great for investors. It should be great for lenders. It should really be good for everybody in the real estate business. But what are you seeing right now? Are you seeing people waiting and holding a little bit, waiting for those interest rates to take those drops? Or are people still moving forward thinking, I'm going to buy now, and then I'm just going to refinance when they do drop?
Both. And those people couldn't be too farther away from each other. So it's, the national media does a really good job of scaring people. It's a lot of fear mongering. But no, then there's the opposite side of that. Like, what's Warren Buffett say? Be greedy when others are fearful. And, the savvy people, they will just use this opportunity to go under contract at asking price. They're willing to risk a $500 to $700 inspection period report. And then some of the guys that I'll work with call it bending them at the binder. They will use that as a negotiation strategy, because once that seller is under contract, emotionally, they just booked their vacation, they're on the cruise ship, the house is sold. Little do they know, the savvy investor is using that inspection period as the meat and potatoes of the negotiation. So then they'll ask for 6% seller concessions. And they know if they're not going to get that, then they're not going to hit their cash on cash return that they want. And so 6% in seller concessions can buy down the rate or really take a nice haircut off of all the cost. And if you buy down the rate or take a haircut on the cost because the seller's paying for it, guess what that does to your cash on cash? It goes up.
Yeah.
And so there's just some people are willing to play that game, some aren't. And then the other people that are first-time home buyers, it's just harder for them to see that. But, if they got a good agent team working with them, and, you can still get rates in the threes right now, basically 3% under what you'll see on Google or Bankrate or some of these other places with temporary buy downs. So if somebody really wants a more affordable payment, you don't pay points. The seller does it for you. So it's almost like an annuity that comes with your mortgage that contributes to your payment for 3 years. it's something that I think the people that are super, super payment sensitive to really like. But if you get 6%, 5% seller concessions, it makes the deal so much better. And 3 years ago, that just wasn't part of the process. It was, you had to pay over asking, waive contingencies, and that's why they call it a buyer's market right now.
Has there been any, I know that, we had the COVID era where there were so many people buying short-term vacation rentals, and they were renting like crazy, of course, because, you didn't have any boundaries. Our kids were at home, so you could get on the road. People could go work wherever they wanted, and they were taking advantage of that. And all of a sudden, there's a big uptick in the short-term vacation rentals. And then what happened, of course, is that came back down to normal levels, not bad levels, but normal levels. Had you seen a lot of people get caught up in that, where they bought based on a set of assumptions, got lending, and then got stuck?
Yeah, exactly. So if you're not willing, this is a hospitality industry. So before I got into lending, and my first job was working in a restaurant. I was waiting, bartending, and it's all about the experience you create. So, I didn't think it got saturated with a lot of extreme, you got a great background on the podcast right now. And if you're not willing to create an experience, that something that you put time and effort in, that you could take your kids to, or whatever your avatar is that you're trying to advertise to, bachelor parties, whatever, then you're just going to fall way behind. The professional hosts know that you have to have experiences. You have to have a cowboy pool. You have to have murals. You have to have a game room, depending on the market, right? And so it's all about the market research. So gone are the days that you can use iPhone photos and Facebook furniture like it was when I started in 2015.
Mm-hmm.
Now, if you're in a competitive market, I live in Scottsdale. Scottsdale market is way different than some of the rentals that I own in Indiana, and way different than some of the markets that I own in Florida. So it's just really, really knowing your market and knowing how to allocate any of the funds you have to put you, if there's no way for you to be in the top 5%, I would argue you might need a different market, but the money's still there. I just, what I did was convert some of mine to midterm rentals, because I didn't want to me personally, I didn't want to spend $100,000 to turn my backyards into resorts.
Mm. Well, and you're invested in Indiana?
Yeah, I'm from there.
Okay. That's one of those markets where it'd be like, I don't know if that's a resort type market. Was that one of your long-term conversions?
No, I have, I'm on page 1. Well, I have 2 listings there. I converted them from long-term rentals into short-term rentals. Okay. I didn't like my long-term property manager at all.
Yeah.
They've been working. So it's, I got family there, so it just makes it easy. I can block out some of the calendar and go back, I'm in Scottsdale. So summertime and especially autumn, it's just beautiful in that part of the country. So, that's why I still keep them
spread out. I mean, so you grew up in Indiana though, right? Did I read that somewhere that you grew up in Indiana? So is that your tie to home?
Yeah, I spent 27 years of my life there. Been in Scottsdale for, 13 years. And so when I first got into real estate investing, the first house I bought was $500,000 home. And then I'm like, well, I don't have enough money to go buy a whole bunch of these other $500,000 homes, but real estate's cheaper in my hometown. And if something goes wrong, I got family and friends I can lean on. So, bought a house for like $8,900 on Facebook.
Oh my gosh.
And put 30 grand into it. It appraised for 150. Then I put a loan on it, paid myself 80,000 in cash. I'm like, well, that worked out really well.
Yeah.
And then went and bought some more house, just your typical BRRRR, which is you buy an ugly house, you rehab it, and then you refinance it and pull out the money from the house like it's an ATM or a piggy bank. Then you use those loan proceeds to go buy whatever you want. And I just chose to kind of roll that back into real estate. And then one of the mistakes I made was I probably should have rolled that money back into Scottsdale, but I just started looking around at different markets. And my top performing property is in Florida, but I think from a scalability standpoint, I probably should have reinvested either back in Indiana. The reason I don't want to do that is because you don't get the appreciation like you do in the Sun Belt states. assets.
Right.
So, but yeah, it was a fun journey. That's where I started.
It's really interesting that you're talking about the appreciation, because I just had this conversation the other day. Somebody was talking about, I forget what market it was, but it was one of those markets where they're like, houses are only $50,000 in this market. And I was like, well, it's probably going to be worth $52,000 in 10 years and $53,000 in 15 years. It's kind of one of those things where it's like, if you're really going to build wealth, long-term wealth, get in the appreciating markets, because you're going to see such a great, a much higher return by going into these markets that appreciate it at this rate versus this really slow burn rate.
Exactly. Where would you rather own? On Manhattan Island in New York or in Indianapolis? All things created equal besides a zip code.
And it's kind of one of those things. I remember Scottsdale back in 2008, 2009. I mean, you were buying properties out there for $100,000, $150,000, pretty decent properties at that point. Of course, you had the big crash going, and everybody talks about real estate and going, well, I'm scared to buy real estate. Well, it's risky. And I always say, and if you could have bought, if you could have bought, let's say, $1 million of property back in 08 and 09, you would be so wealthy right now, it'd be ridiculous. You would have more than 10x your returns. You would have probably, 50x based on what was happening during that time period. So right now, everybody's been kind of waiting for this next big drop. I don't think we're going to do it. I think we're going to push through. We have seen kind of a little bit of a leveling off compared to where we were at on property values and pricing. But I'm telling people, it's like, get in. I mean, real estate over the long term is going to be always cycle, but it's always going to consistently be going up. Hey, everybody. I hope you're enjoying this episode of the Vacation Property Secrets podcast. I want to let you know about one question that I get all the time. And that's, how do I forecast my cash flow and my profitability when investing in a vacation home? Now, if you've ever wondered that, or you know somebody who has, you're in the right place. We've created a free training called Financial Forecasting for Maximum Vacation Home Profitability. Now, in this training, we're going to guide you step by step on how to accurately project rental income, estimate your operating expenses, and calculate your returns so you can make informed investment decisions. You can access the free training at vacationpropertysecrets.com. So if you're ready to dive deeper into financial fundamentals and maximize your profitability, visit vacationpropertysecrets.com.
I think it has a lot to do with, the monetary policy of the United States, and I think the monetary policy is to debase the dollar. And they do that by creating more dollars. And I don't know if we're going to have a COVID printing session, but I do believe that the dollar is going to debase, and the easiest way for the government to control that monetary policy, and this is a lot of mortgage jargon, sorry, but they just lower rates. That's what happens. And then all the hard assets, real estate, commercial, residential, and gold, Bitcoin, all that stuff will be affected, and assets will go up.
Yeah, I always tell people, it's like, well, if you want, they're like, well, when will our rates get back down to where they were? And I say, we're going to have some pretty big economic impacts happening to get our rates back down. I mean, when they'll start moving the rates down is when we're going in the wrong direction economically. And so it's like one of those things. It's like, it's always a balancing act, right? Between the two. Where's the economy heading? Is it heading up? Is it heading down? Interest rates are probably going to go opposite of that. So if, things are going really bad, they're going to start pushing rates down to try to drive the economy back again. So inflation goes up. What do? Well, they're going to raise rates and then try to push it back down. So, I can recall, and I don't know, I'm probably a little bit older than you are, but I can recall when interest rates were, above 10%. When we used to go in and look at properties, we're 10 capping properties. You could take a Walgreens with a 30-year lease, and you're going to put a 10 cap on it because people are going to be looking at a 10% return based on lending. Mm-hmm. And then all of a sudden, when we were hitting 3%, I had never seen something like that in my lifetime. My parents back in the 70s complained about their 16% interest mortgages that they had back then. And, that was an era that I didn't experience either. I've never had to experience that type of loan, but it's always in flux. And, real estate, the values, are either going to, when interest rates are way down, values are naturally going to start going up because people can afford more home. Interest rates go up, then pricing tends to come down a little bit because people can afford less.
Yeah, we've had, it feels like a longer time when all you do is talk about rates, but rates have been elevated for, next March will be going on 3 years. So, they moved pretty quick. It went up fast. I think it's like one of the fastest times interest rates have risen. And, there's been some pullback here in the last 30 days, but, people they'll call, they're like, well, what happens when they cut rates? I'm like, that's already going to be priced into the mortgage rate that you're going to talk to one of us on the phone about right now. So, I always tell people, make the best decision for you, but it's kind of like with equities. It's like, you don't want to time it. It's about time in the market. So the longer you own the home, if you're thinking about buying, you shouldn't wait. It's about time in market. If you bought Apple 100 years ago, like, it's obviously better than sitting around and waiting for the dip, because you never know. Just, same with houses. If you have the money to buy now, then just do creative things like house hack to offset the housing expense. And that, that's what I try to tell everybody, make it relatable. Like, it was expensive for me when I bought my first home because my salary was less. But, everybody that knew me was like, don't do it for these million reasons. And I'm like, forget you guys. I carved my own path. I got this all thought out. I'm doing this anyways. I'm going to buy the house because it's a nice asset in a nice area. I'm going to move people in. They're going to pay the mortgage for me. I'm going, instead of living in a 2,000 month apartment, right, and nickel and diming, now I'm going to live in a $500,000 home, live for free, and I could travel every month if I wanted.
Yeah.
And so I'm like, if you just sacrifice for a short time, the rest of your life can really change.
Well, and real estate is one of the biggest ways to build wealth out there. I mean, a lot of people think that there's so many different, and there are a lot of different ways to build wealth, but real estate is consistent. And I mean, it's one of the strong, even if you're not an entrepreneur, even if you've got that job and you're going to work, and if you don't own your house, you're missing out on a great opportunity to build wealth, and not just wealth, but generational wealth that you can pass down into your kids and such too.
Yeah, exactly. Then you just got to figure out how to shelter it from taxes, and it's always a good shelter from inflation, but they've proposed some ideas about unrealized gain taxes. I don't know how that's going to turn out, but we're hoping that we can shelter wealth through real estate for a long time, because I always thought that's been a part of the American dream. You just buy the home. And I know right now that's where most Americans' net worth is made up of. It's the equity they have in their primary home.
Yeah. So if I'm sitting there, I'm at home, I'm thinking about buying a vacation property, I don't know where to start with lending. What would you suggest to that person for a starting point?
That's a good question. Just come up with a plan. It's like, I always try to reverse engineer. So like, if I really have to think about what I want to do, and I know I want an investment property and an Airbnb, I would just ask myself, and, I came to the conclusion that my why was because I used to write this down. It's different for everyone, but I wrote down 36 holes of golf a day. Now, I don't ever play 36 holes of golf a day, but I knew if I could live my life in a way that somebody paid my bills for me, it would give me the autonomy to be able to do that. And just to have that kind of control was ultimate for me. And with my handicap, I definitely don't play 36 holes of golf a day. But that just gave me the idea. I'm like, wow, so if I had enough rentals in order to do that, at least it would be possible. Maybe I can spend all that time with my family. But different reason for different people. And I didn't have a family at that point. Now my reason would be different. So it all just depends. Some people might do it for tax purposes. If it's just for cash flow, the most amount of cash on cash or the highest performing property, then the first thing that they should do is contact somebody that'll help them underwrite the property. That could be a mortgage lender, could be some agents. Not agents or lenders enjoy doing that. I don't want to promise returns. Most agents don't want to promise returns. But there are services like STR Search. Kenny Bedwell has a service where they literally will help them handpick. I always just say, make sure that the person that's spoon feeding you does the exact same thing. So that way, you're getting legitimate information. I always tell everybody you can more than happy to look at my Airbnb profile. I've been doing it since 2015. So it's just putting yourself in the right room. I don't think somebody should just go out and buy a vacation rental the next day if they decide they want to do it. I think to go to a conference, join a Facebook group, just start realizing if they like hospitality, because yes, I have virtual assistants and AI run a lot of my business, but it's still hospitality. You never know what lever you're going to have to pull at any given time. And I try to pride myself on only spending a couple hours a week on my short-term rental business, but that doesn't happen on day one. There's a lot of effort that goes into it. And so it always just goes back to why they're wanting to do it. And, I learned everything off YouTube. Everybody's different, but I would just say really focus in on that why. And then you can find, that's where you can start your education process. And then, finance, I think you should go to the loan officer before you go to the real estate agent, because I pay for a technology that I pay $250 a month for, and it tells you the performance of loan officers and real estate agents. So that way I could say, if you go to this real estate agent, they are in the top 1% of helping buyers nationwide. They're going to get you the best deal. And so agents don't have that technology for them because they don't need it. But whenever they come directly to a lender, I could say, well, what market do you want to look at? And then I'll make sure to find you the best agent, not one that has the best Facebook reviews, but the one that actually closes the most deals for buyers. And so it's public information. You just have to pay for that data. But it depends on what part of the process they want to start at. But I would say start with their why and just educate around that as fast as you can.
So, but a lot of people are scared of the lending process. I mean, they're scared of it, especially people who are maybe not going to qualify for traditional lending. What would you tell those folks? Would you say, hey, don't worry about it, just get it started, or what's the best advice for that person?
Yeah, just I would just say, I totally understand, but here's the thing. America rewards people for taking action. Doing a loan application and getting pre-qualified is not fun, but it's rewarding. You probably work really hard to be rewarded. Just work really hard for a short amount of time and you can be rewarded in real estate. It's the same. There's no free lunch, but you're with the right person. What questions do you have? And it's just, what do you need to see? And just being an open book, being very transparent, but it's with anything in life. It's the people that want the down payment assistance still don't want a house because they're realizing they have to do things to do it. And it's so easy in life just to coast by. But if you can, it goes back to what I was saying, if you can just sacrifice for 1 year, it can really change the trajectory of your life. And, when I tell people, it's not about look, I know I'm here with you to work on the front part of the loan and make sure that you understand that, yes, it can be a little inundating, but I promise you, if you just work through every part of the questions with me and my team, it'll all make sense to you. And my goal isn't to close the transaction. It's 6 months after we close it that we call you. If it's an Airbnb and we talk about how much money you're making. And, my goal as a lender is not to close a transaction. It's to make sure that you close on a successful transaction and a successful hospitality business, because then I get to call you and do my favorite thing. And let's ask if you know anybody else looking to buy, sell, or refinance to help the next person, because it's rewarding. Because I'll get on a call. It's okay, so that's your number. So we need 3 Airbnbs cash flowing $3,000 a month. And now you can tell your wife she can quit her job. That's pretty powerful stuff. Let's get the next one. So
yeah. Well, and that's another reason you want them to be successful, because you want them to get to the next deal and to the next deal and to the next deal. Mm-hmm. But you got to love what you're doing too. You got to love buying. I just love it, man. I love every part of the real estate transaction. I love it from from the negotiating to the putting the deal together to doing the analytics, and for people when they're out there and they're doing this, once they get kind of that fever, if you will, of really enjoying doing deals, I mean, there's nothing like it. I mean, it's kind of like seeing that growth and seeing the opportunities and then going into outperforming markets. I mean, it's a wonderful thing. So you're right. A little bit of sacrifice leads to a whole bunch of enjoyment.
Yeah, Well, whenever they don't want to do the application, that's the first point of everybody wants to hop on a call and talk. But when it comes to doing the application, that's always the first point. But it's like, how rough is it really? I know with an iPhone, you can do most, like 80% of that stuff in like 30 minutes or less. And so it can be very, very simple. But, if you can't use ChatGPT to fill out the application for you, that's just where we're at. And I know loans will eventually catch up to the technology that we have today, and it is catching up in some areas. There is AI, and it's very helpful. But there's some great. If you're a first-time home buyer, man, it's a good time to buy when it's a buyer's market.
100%. Drew, I want people to be able to find you to get information from you, or if they're looking at getting some lending, you'd be a perfect guy, especially with the short-term vacation rental folks. Where do they need to go to find you?
Drew Do Loans is my handle on Instagram, TikTok, YouTube. You can't really have direct messages on YouTube, but Instagram is great. I love the messaging feature there just for business purposes alone. But I have a lot of educational stuff on there about credit, seller concessions, how to negotiate prices. I just try to give back as much as I can. But if you guys have any questions, that's the best place to reach me. Drew Do Loans.
Got it. And then just the last question I ask everybody, if you could give one piece of your most valuable advice to that person who's out there, they're getting into the market, they're wanting to start to buy short-term vacation rentals, what would be your strongest piece of advice for those people?
Just figure out your why and just work backwards from there. You need to figuring out your why is just a lot of people just hear something and then they just want to do it. They think it would feel good, but why would it? Just go one level deeper. Just figure out your why. And I think that's the most important reason. And mine was 36 holes of golf a day because I wanted to do that. And just to say that I could I do that and my business still operate? Yes. And it's different for everyone. Somebody might want to eradicate a massive tax bill. But then that could cause somebody to not have to work anymore in their family. So it's just figuring out your why.
Yeah. Drew, thank you so much for being on the show today.
Pleasure.
Thank you for tuning in to this episode of the Vacation Property Secrets Podcast. If you enjoyed the show, we'd really appreciate it if you could leave a rating and a review on Apple Podcasts or Spotify. By leaving a review, you not only support the show, but you also help others find and enjoy it just like you did. Also, please share this episode with somebody who could benefit from it. And if you're aiming to build a short-term vacation rental investment business that's based on strong investment fundamentals and not just emotion, I'd love to invite you to a free training that I'm hosting. It's my financial forecasting for maximum vacation home profitability training, an on-demand video course that's completely free. It walks you through the investment fundamentals to build and scale your short-term vacation rental business. You'll also learn how to estimate investment income and your operating expenses to build a projected pro forma operating statement and the potential NOI and return on investment for your property. Just go to vacationpropertysecrets.com to get access to your free training. We'll see you next week for another episode of the Vacation Property Secrets Podcast.